Hi, this is Brandon Bischoff. I'm a Vice President of Portfolio Strategy here at Canterbury Investment Management.
And I'm Tom Harden, Chief Investment Officer of Canterbury Investment Management, and I can say that I, for one, feel much better today than we were feeling the last time we did a video.
The last video we did actually came out on March the 23rd, which just so happened to be the absolute bottom, for now anyways, of this current stretch that we've seen in the market.
Yeah, and what I'll do is give you a quick review of what the market's done over the last couple months, which feels like a year or so. But if we go to the peak, which was on February the 19th, the volatility was extremely low. Everything seemed to be just fine, as we've talked about before. We can see a correction in the market at any time. They're typically unpredictable, of about 8 to 10 to 12%. That's just the price we pay for liquidity. And we had a normal correction that lasted for about 15, 18 days or so. And then everything changed on March the 9th. We were at a normal correction, and all of a sudden the market dropped about 7 or 8% in one day. That was a trading anomaly. A day like that should happen about once every billion plus years. And then after that, we had one day after another that were up down 5, 12, 10%.
Mm-hmm.
And from that point on, over the next about 11 days, the market dropped another 22%. And then we did our video. From that time on, we'd say, well, wow, we just had a 34% drop over 23 days. What are the probabilities of seeing something like a 27% advance over 15 days?
I'd probably say very unlikely.
Yeah, but if you remember in our videos, we said markets overreact both ways, and we have trading anomalies. The advances are generally just as strong as the declines.
It's that snapback rally that comes from that stretching of the rubber band that we've mentioned a couple times.
Right, so markets tend to discount things quickly, and then they overreact because of the panic of investors, and then on the other hand, they overreact on the upside. And as it stands right now, we're about 15 or 16% off the old high. So again, I think the idea that the whole economy is shut down at this point and we don't have a vaccine for the virus, etc., I would say that there's probably more risk in the market right now than there is upside return. So Brandon's going to talk a little bit about the strategies that we've used. First of all, we can't predict an anomaly like this, but you have to have a strategy to deal with the unpredictable and the unexpected.
Yeah, so one of the concepts that we use here at Canterbury is called the benefit of diversification. And to just give you an example of the benefit of diversification, if you take all the securities in your portfolio and look at their volatilities and how they're moving and how they're kind of correlated to each other, and you find a way to quantify that. So the benefit of diversification is saying if you have a benefit of diversification of 0%, that means all the securities in your portfolio are moving in lockstep. The portfolios, everything's highly correlated. Mm-hmm. On the other hand, if you have a benefit of diversification of 100%, then you're basically over-diversified. Your portfolio is moving flat. It's not going anywhere. So typically in a bull market, we like to keep our benefit of diversification somewhere around 30% on average. So kind of heading into this environment, that's what we had. And we had a lot more equity exposure because equities were in bull market states for the most part. So as soon as we see that sort of 10 to 12% correction, that benefit of diversification number sort of holds up. But then when we enter that trading anomaly, we start to see all the securities within our portfolio start to become more highly correlated.
They're all moving together in the same direction.
Exactly.
So what happens then is the portfolio becomes inefficient. So the natural thing that you think that you'd want to do is to make it efficient again and lower the volatility. Mm-hmm. But if we do that, what happens?
Well, then you're going to get that inevitable kickback, and your portfolio will not participate in that. You'll make the fatal flaw of having less exposure on the way up than you had on the way down.
So as we had our rebound, our portfolio went back up about 17% or so. And as the market began to go back up and as our portfolio went back up, then we could begin the stabilization process.
Yeah.
And the way we stabilize the portfolio is through the use of inverse exchange traded funds. Now, an inverse exchange traded fund moves the opposite of the underlying index. So if the Standard & Poor's 500 went up 10% and we owned the inverse of the S&P 500, it would go down 10%, or vice versa. If the S&P went down 10%, the inverse would go up 10%. So then you would be increasing your
benefit of diversification. And so just to give you an example of a couple of the different positions that we've taken throughout this to help stabilize the portfolio. On the equity side, we've taken a look at the equities in our portfolio and made some minor adjustments. For instance, the NASDAQ was outperforming, so we took a position in a NASDAQ ETF. But we also saw that the Russell 2000 index, or small caps, were underperforming. And so as Tom mentioned, inverse ETFs, we took a position in inverse Russell 2000 as a sort of a defensive position. And then as this market's really sort of snapped back, there's been points along the way where we've added various indexes. So for example, the EFA, we took an inverse position in the EFA recently.
Which is European, Australian, Far East, Large Cap, International.
And then one of the weakest sectors right now is actually real estate. So within the past couple of days, as the market's sort of gotten its 50% kickback or 50% retracement, we've taken an inverse position in real estate.
Right. So, Raymond, can you take a minute and explain how the changes we've made in the portfolio, particularly over the last week, have impacted the benefit of diversification within our portfolio?
Yeah, Tom. So as we discussed, when the market was experiencing that trading anomaly or that first leg down, our benefit of diversification was actually decreasing because the securities within our portfolio were becoming much more highly correlated and moving in lockstep. And what we didn't want to do is we didn't want to take the steps to improve our benefit of diversification, because we've been talking over this past couple weeks that you're going to get that kickback rally. And so if you take those steps to improve the benefit of diversification by adding those inverse ETFs during that leg down, then you wouldn't have participated in the kickback rally.
Yeah, and that's the fatal flaw.
Yeah, right. So I believe our portfolio was able to go up about 17% during this sort of kickback. And now as we've seen that 50% retracement over the past couple of days, we've had opportunities to more stabilize the portfolio and bring our benefit of diversification up to 60%.
And we've done that by adding to our inverse positions. So right now the bottom line is that the market is at a point where it has more risk than it has upside potential. Probabilities are that we'll see another leg down. The portfolio now is relatively stabilized, which means that it shouldn't fluctuate nearly as much as the market, and from that comes a benefit. And the benefit comes from the fact that if we drop less when the market goes down and then rebound off a bigger base each time, you begin to get that ratchet effect to where we can actually make money in an environment like this, even though the market might be sideways to potentially down.
Yeah, and that sort of brings us to the end of this short video we've done. We've hoped this has helped explain adaptive portfolio strategy and how it navigates this current environment.
Great, so stay healthy, and we will look forward to talking with you again soon.